Welcome to the Module 1. I'm Dr. Priyanka, your mentor for this course. In this module, we are going to learn mainly three things: what is accounting, why it is so important, and who are the users of accounting information. So let's start with the definition of accounting. Accounting is a systematic process for first identifying and then recording the financial information about business. After that, providing summarized statement about the company's financial performance as well as position to the users who require such information to take future decisions related to the company. And then interpreting the financial statement and preparing the report on it by analyzing the financial statement, then communicating the same to the users of accounting, including the management as well as investors. What does identifying business information means? Well, it means that there are number of various activities in the business, but we cannot write every event or transaction in the books of accounts. Accounting is based on monetary assumption, which means only those events or transactions are recorded which can be measured in the terms of money. For example, salary paid to the employees, rent paid for the office, or insurance paid for the business. All these activities require money. So they have to be recorded in the books of account, and of course they are significant to the business. But if there are activities such as training of employees for enhancement of their skills or hiring any new employee by the HR team, well, they cannot be measured in the monetary terms, thereby cannot be identified as the financial event. So we will not record them in the books of accounts. Why accounting is so important for everyone to learn? Well, it is important for everyone to learn because even if you're not directly dealing in the money or you're not in the finance department of your company, but still you should know about the basics of financial accounting. Well, any business uses the financial accounting to keep their financial information organized, which helps the business to take the future decisions and also to meet the compliances of financial regulations. For the other users, it helps to take financial decisions. For example, the investors, they might take the investment decision related to the investment by evaluating the financial performance as well as position of the business. The objective of accounting is to provide the information to the users for decision making. But let me ask you one question: who exactly are these users of financial statements and what information they need? In this video, we will learn who are the users of financial information. The three primary users of accounting information are internal users, external users, and the government. Well, government comes broadly under the external users. Each group uses accounting information differently and requires the information to be presented differently. When you present your financial information with the external parties, you want to show that your business is really good so that they can invest and have more deal with your company, right? If you present your financial information to the government, then you just want to show that you have earned very less or actually nothing, because they will take all your money in the tax. And when you have to share the information internally, you actually want to represent only correct and accurate information so that you can know how your business is running and you can take future business decisions. So let's see first the internal. These are the users which are inside the business and controlling the organization, such as the owner, who uses the financial information for shaping the decisions about when to borrow or invest the company resources, the decisions related to the expansion or downsizing, etc. The another important internal user is the management, which need the accounting information to evaluate the performance of the organization and the position. Performance of organization means to evaluate whether the company is having profit or loss in the present year as well as compared to the previous year, how well the company is performing. The position means that the position of assets and liabilities at a point of time in a company is also evaluated so that the necessary measures can be taken to bring improvements in the term of business results. For example, the management of PepsiCo company, after analyzing the financial statements, may decide which product line is most profitable, like any beverage or the chips, which product line need to be discontinued. Now let's see the second kind of users, that is external users, which are outside the company and interested to know the financial condition of the business because their money is involved with the company, such as investors. Well, they need to answer the questions like, has the company earned satisfactory income on its total investment? Should the present investment be increased or decreased or retained at the same level? There are some of the questions they look for the answers as the risk is inherent with their investment in the company. For example, if an investor has invested in General Electric, they desire to know whether the company is generating satisfactory income or not so that they can get their dividend on time. Or if you talk about creditors as the external users, they may be the suppliers of the company or maybe the bank which has given loan to the company. They are eager to know that whether the company will be able to pay their dues on time or not. For example, the creditor of United Airlines, maybe supplier, is interested to know that the company will pay their dues on time or not. Of course, they will also look at the credit worthiness of the company. Government agencies like income tax department, sales tax department, they would like to go through the company's financial statements to keep a check if the company is paying appropriate taxes or not. Let's meet in the next video. Thank you.